Okay, welcome to Alphachain Capital. My name is Gavin, and in this session, what I'm going to do is, as we are into a new year, and Happy New Year to you, I'm going to cover some of the 2020 financial market highlights, especially for me, what I found were the biggest movers in financial markets in 2020. So let's get started. Well, naturally, the first and the most important topic has been the coronavirus and the coronavirus crash specifically. So the S&P 500 erased over a third of its value in under a month. It's actually the fastest 34% decline ever recorded on the benchmark index. Do you remember the S&P 500 is seen as the broadest market indicator of strength or weakness, not the Dow Jones or say the Nasdaq. Dow Jones only has 30 companies. Nasdaq has only the tech companies, 100. SP 500 gives you a much better, broader comparison in regards to the top 500 US companies. So we saw a significant 34% decline taking place. This was during sort of the March COVID impact, where we almost went to a global shutdown. As a result, there were a number of sectors that were significantly impacted. One could be seen as the tourism industry, with countless cruise ships docked and passenger flights traveling at half capacity, some even at zero capacity. So yeah, coronavirus crash was one of the most significant, and if not the significant, sell-off that we've seen in a very long time. And let me just show you this. So what we're doing is we're comparing the S&P 500 during sort of major crashes and how much of a drop we've seen and how long has that negative fall occurred for. So if we compare some of the past, so we can see dot-com bubble. This was the 2000 crash. There was 1,808 trading days of negative movement. Okay, and you can see a significant drop around the 49% mark. The global financial crisis, which took place in 2008, most of you should be aware of the 2008 crash, if not the 2000. There was 1,379 trading days in the negative and a 57% drop. But with the COVID-19 crash, it's not the significant drop that taken place wasn't as large as we've seen, for example, with the global financial crisis, the dot-com bubble, and most importantly, sort of the great crash that occurred in 1929. So this is more of a depression, if anything. But it's the negative periods that we had been in regards to sort of this range of a hair. So with the COVID-19 crash, there's 117 trading days in negative, and there was a 34% drop, which took place in a very, very short period of time. Now, how short? Here's another stat. Actually, I'll come to that stat next. So before I go into that, in regards to daily losses that has occurred ever with the S&P 500, let's look at the VIX. The VIX is seen as, it's a volatility index, so it gives you a good gauge of how much fear or greed there is in the market. When it's at the low 20s, around the 20 range, it pretty much gives you a bit more hope and optimistic view in the markets. But as soon as this powers way above the 20 range, that's showing you there's a lot of fear, a lot of panic selling taking place in the markets. And you can see how COVID-19 triggers the biggest VIX rise on record. So we've seen a significant amount of panic selling taking place. So this is inversely correlated to equity markets, which would have fallen in line with sort of this rising. We did see it for the rest of the year actually start to sort of dwindle towards back to the 20 handle and stay around the 20 handle. There was a little bit of reaction with the US elections in November and December. But again, nothing significant. And as you see sort of this period of low VIX range, naturally the equity markets would have fallen significantly, but then thereafter would have recovered as we've seen to all-time highs. Now, this is what I wanted to discuss, was the one-day point losses. So what has been the 10 biggest one-day point losses? And this is on the Dow Jones, not the S&P 500, the Dow Jones, which are incorporating your top 30 companies, right? The last 4 or 5 in this range, as you can see, has occurred in 2020. Yeah. So all of them are in March, all of them taking place in March. The most significant sell-off was on the 16th of March, where it wasn't just equities, it was pretty much all asset classes had sold off, and it was just a day of extreme fear and panic selling taking place. Yeah. So we saw almost 3,000 points just wiped out in a single day of trading on the 16th of March. On the 12th of March, almost 2,350, around that range there. On the 9th of March, 2,014 points. 3rd of March, almost 1,500 points. So this is the most losses in a single day that we've seen in the Dow Jones ever. I do remember there have been now innovation taking place since the 2008 crash, where we have circuit breakers taking place. And with circuit breakers, that means if the equity markets loses a certain percentage, they will halt trading for a period of time. In some cases, they can halt trading for the entire day, just to reduce the amount of sell-offs that takes place in a single day. So what we're seeing is, over time, there has been where we've seen large amount of selling off taking place in a shorter period of time in comparison to many, many years ago, especially in comparison to the crashes that we've seen in the past. So yeah, I mean, the markets are volatile, and it continues to increase in volatility year over year. Now, a key part to the COVID scenario that had taken place is it had only impacted certain sectors. Yeah, so that's where the keyword sector rotation became a major theme in trading and for investors, longer-term portfolio managers, in allocating what assets that they want to be involved in, what types of risks they're looking to take. Excuse me. So it was known as the acronym BEACH. Okay, so BEACH meaning booking, entertainment and live events, airlines, cruise and casinos, hotels and resorts. Each of these were impacted. Each of these sectors were impacted. So yeah, you can see some of the largest impacts was say airlines. Airlines almost 52% down. We saw a Norwegian cruise liner a negative 72%. Six Flags Entertainment down 66%. So the biggest impact happened to these sectors. In fact, with COVID taking place, there were other sectors that outperformed, which I'll cover a little bit later. Another key part to 2020 was stimulus packages. The amount of stimulus packages occurred globally, so not with one central bank, it was global central banks. So the Fed, the BOJ, the BOE, and so, the ECB. Each of them had done a significant amount of fiscal stimulus. And if you compare the amount of stimulus packages that was taking place, you can see sort of, where we are in regards to numbers. And you're looking at sort of comparison to World War II in some key parts here. The UK, the US, Europe, Japan, doing the majority of fiscal stimulus taking place. And the amount of money being supplied into the market, so M2 money supply, which is quantitative easing, is one of those sort of key areas. So interest rates came off significantly, very quickly in March. But not only that, is the amount of printing money that had taken place. And you can see the comparison between the 2008 to 2010 global financial crisis, which had taken place, and to the global coronavirus crisis, the amount of money being supplied. Another key part, as I mentioned a little bit earlier, was that there were some sectors that had outperformed. And one of the main sectors that outperformed was technology, especially big tech dominance that had taken place. Now, naturally, if you're sort of working in a home environment and you're not going to the office, you'll be using more software and tools and technology to help you to keep up with the workload that you may have, right? So we saw, instead of face-to-face meetings occurring, we had more Zoom meetings or Skype meetings, right, taking place. So this is a chart comparing most of the sort of equity markets you are able to trade. So you can see FTSE being right at the bottom there, the least amount of recovery, but that could be more due to Brexit. Okay, so I'll cover that a little bit later, but this is more due to Brexit, or in regards to the lack of recovery taking place there. But you can see the DAX, the Nikkei being in this region over here, the Dow Jones, the the SP 500, and so on. So in this region here, the one that had, even though we saw a recovery taking place, and most of these did go on to recover from that initial sell-off that had taken place in March. This was that sell-off, that panic selling. We had those 4 or 5 days significant sell-offs taking place. The recovery had been good, but it has been substantially, in the Nasdaq 100, which has gained 65.65%. Sort of not from the lows. I mean, if we took it from the lows, I mean, it's you more than sort of 100%, but we're sort of covering from this point over here. But yeah, as you can see, sort of the Nasdaq's performance has dominated and been the leader in regards to the equity markets. So this is another sort of longer term view in how big tech and sort of just technology sector on its own has outperformed, not just in 2020, but we're looking at multiple years from that initial the dot-com sort of bubble that taken place in 2000. Thereafter, we've just seen a strong drive higher taking place. And this is another acronym, FANG-M. This is incorporating some of the big sort of tech firms. So you've got Facebook, Amazon, Apple, Netflix, Google, and Microsoft. Those are your sort of firms there. And they have sort of outperformed since 2013. We're up by 503%. And if you compare that to S&P 500, which includes those stocks, that's 110%. But excluding those stocks, if you'd chosen other sectors within the S&P 500, apart from tech, you would have been up 70.9% only. Yeah. So it's not a most recent trend in 2020. That's only just made it significantly more greater, but it has been a very long-term bullish trend. Another key area for myself was the fact that oil prices had gone negative. Okay, oil prices had gone negative. It's the first time that's ever occurred, by the way. So it's a historic event. Oil prices went negative for the first time in history. Futures contracts. So this was in the futures market only. It's not in the spot market. The spot market would have gone to zero, but not to negative. Futures contracts for WTI oil fell to a stunning negative $37.63 on the 20th of April, with producers actually paying traders to take oil off their hands. Just to give you some of the fundamentals leading up to this, you can see sort of February 13th, China begins turning away oil tankers as lockdown intensifies, sort of in the Asia Pacific region. Then we have sort of OPEC plus talks collapse, so they didn't come through to reducing the supply in regards to oil. So Russia walks away from negotiations. Saudi Arabia offers $68 price discount to customers in Europe, Asia, the US. We're looking sort of, as that proceeds, the WHO declares a COVID-19 pandemic. And then the final sort of straw was the 9th of April, Saudi Arabia, Russia finally agreed on cuts. But by then it was just too late. And was it enough is the key question that I remember from that discussion. We expected a far greater cut than actually occurred. So oil prices hit their lowest point since 1990. And then thereafter, this is what took place. Okay, so we saw in a single day the price going from around the sort of $20 region all the way down to sort of negative, as mentioned, $37. Okay, there was some, shall I say, retail traders or prop traders in Essex that had actually made the majority of money on shorting this the oil market on that specific day. There's actually an investigation taking place by the SEC in regards to their shorts that had taken place is a group of traders working from their own homes in communication through WhatsApp or whatever it might be, had shorted this the futures contract and made most of the profit. So the SEC are looking into this and investigating. I'm not going to go too much detail. There is no sort of deciding factor whether there was any manipulation involved or insider trading, but we'll see what happens in regards to that investigation. As mentioned a little bit earlier, the world works from home. So, we saw a significant shift. In 2018, I remember talking about this. I remember talking about this in 2019, that there was a growing demand for remote working or, flexible working hours and things like this already in discussion. But in 2020, it almost became mandatory to survive. You needed to sort of work from home. So we saw a shift, to stay at home. Has resulted in a much higher reliance on technology for many people. Nowhere where these trends exemplified more than the rise of video conference software, such as Zoom. The platform was used for work, education, and socializing alike. Okay, so to put that into perspective, if we now compare two sectors, we're just comparing one company to an entire sector, right? So we're comparing Zoom communication and its market cap, which had grown substantially, right, from in December 2019, 10 million users, March 2020, 200 million users, April 2020, 300 million users, with a market cap of $48.78 billion, right? And now you're putting together most of your airline sectors in the US: Southwest, Delta, United, IAG, Lufthansa, American Airlines, Air France, KLM Group. And the total to that is 46.21 billion. So it just shows the growth in especially technology software that has occurred in 2020. Okay, another sort of a key highlight to my year, especially as I had shares in this and done substantially well, was Tesla. Tesla becomes world's most valuable automaker. So in 2020 was a hallmark year for Tesla. In June, it became the most valuable automaker in the world, surpassing the likes of Toyota, Volkswagen, and Honda. So if you do a quick sort of view over here, this is showing you Tesla's market cap here around the sort of 183 billion mark. That was then, that's a little while ago. Since then, it's done a stock split. It's now been entered into the S&P 500. Shares split from around $2,200 down to around $400, and the shares were up from what I heard yesterday, $750. So it's almost doubled in price there. So it's significantly higher than 375% from what I know. So yeah, Tesla is now the world's most valuable automaker in comparison to all of these brands here. And do remember, it was yesterday or over the weekend, Elon Musk tweeted that they produced, in regards to vehicles, 499,950, I believe, vehicles in 2020, and their goal was 500,000. So if you compare how many cars that they build in comparison to some of these other brands, it is small. It is a very, very small amount. But as they say, technology is taking over. Now, finally, we come to sort of the 2020 crypto boom. Okay, so digital currency markets have climbed significantly in value, but despite the gloomy sort of economy and the aftermath of COVID-19 responses. So Bitcoin price has been hovering at record values, record levels as we begin 2021, and the top crypto assets in terms of market cap has gained 300+% since January, 5th of January 2020. So just do a comparison over here. So this was taken 5th of January 2020, where Bitcoin, this is the market cap, so 134 billion. But look at the price, it was at $7,400, $411. Okay, Ethereum, Ether was at $136 for one Ether. Ripple, about 19 cents, and so on. Okay, so that sort of gives you an indication of where it was at the beginning of that of the 2020 sort of year. Now, do remember, as I mentioned, we saw 16th of March and the 12th of March, a significant amount of selling pressure occurring in all asset classes, which did include cryptos. In fact, Bitcoin came close to reaching, I think it was 3,600 or was it 3,800, in that region there. Between 3,800 to 3,600, we saw a spike lower. It depends which exchange you're viewing crypto assets as well. But it's ended the year, as you can pretty much see, way over $30,000. So now, looking at the 3rd of January 2021, Bitcoin is at $32,782 for one BTC. I think the highest reached around just shy of 35,000. Ether, as I mentioned on the previous slide, was around 136, is now at 975. Over the weekend, it had surpassed $1,000 for one Ether. Okay, we've seen a few more sort of entrants into this. We've got Polkadot gaining substantially as well. So yeah, that's some of the sort of crypto assets. And just to show you sort of I like to show once in a while sort of the performance of my trading as we progress throughout the year. So this is sort of Q4. I only trade BTC, so I hold crypto assets. I've got a variety of crypto assets that I hold for the longer term, but trading, I only focus on BTC. That's the only asset that I just trade. And when I do trade BTC, I tend to trade it on more of a swing term, generally because we often see that there could be a lot of ranging days occurring in BTC. I don't want to be sort of scalping and taking positions on a 1 5-minute time frame reversion to mean setups, purely because of the volatility that can occur in BTC. So I've got a more of a swing trading position, and you can see sort of the final quarter, that's a remarkable sort of quarter, was up 405%, and you can see sort of most of this is adding into positions and taking profits at different regions, right? So it's up 70%. This is sort of when I look to really take the majority of my profits in this region here. I like to add into positions rather than look to take a position, close a position, buy in again, close a position. No, I like to sort of accumulate as markets trend. And I mean, Bitcoin had a beautiful trend on the 1 hour and the 4 hour time frame. Now, just an overview, the winners and losers of 2020. Well, starting off with the losers, as travel came to a standstill, oil consumption and demand dropped along with travel and airline equities. This is where we saw the most significant amount of sell-off taking place, right? Now, Carnival Corporation, energy stocks, Air Canada, all these were down substantial amount, double figures. WTI crude oil, we saw that significantly down, but look what it is now, right? We've seen all of a sudden now, we're almost, I'm just looking at US oil right now, we came close, touching distance to the 50 handle, $50 a barrel handle. The FTSE was the laggard out of all the equities, as I mentioned, due to Brexit. So only sort of a 40% sell-off there. Dollar index, because of the amount of QE, the amount of printing money occurring, it devalued the dollar substantially. Shares of vaccine manufacturers like Novavax and Moderna hit various multiples as their trials progressed. So a key area I'll probably say is, for me, what I saw in 2020 year was the year where discretionary traders had, really profited the most in regards to systematic and discretionary traders. I truly believe that. I don't think algorithmic traders or quantitative traders actually did rather well in comparison to discretionary traders, because the majority of the moves were based around momentum occurring in the markets and a lot of speculation. Okay, I'll touch on the speculation part a little bit later. Momentum, I mean, what proves it? Look at IPOs. All IPOs surged on average around 108%. That's momentum, right? A new stock coming into the market, and all of a sudden it's driving higher and higher and higher for a number of days. Again, another momentum play. Bitcoin was past 300%, but yeah, let's just go with that 300% mark. Zoom, we spoke about that a little bit earlier, the growth in Zoom. Moderna, I mean, pharmaceutical, naturally, with COVID taking place, everyone's in a race of getting the vaccine. We've got 3 or 4 vaccines out already. 2 have been approved in the UK. So yeah, I mean, there's a huge demand there with Moderna and Novavax sort of almost 3,000% there. Tesla, as I mentioned a little bit earlier. So these were your winners, these were your losers. And of other sort of notable sort of mention, and the reason I've highlighted them here, but I didn't really sort of go into and stress into it purely because each of this actually lacked that short-term momentum drive that you would expect to occur in financial markets. I really wanted there to be a significant move occurring and be a little bit gobsmacked from that move occurring, and none of that happened. It wasn't as expected. Now, the first one would be the US presidential election. Yep. So the reason this wasn't as significant as I've traded 2 or 3 elections from the US. The last election that I traded was obviously when Trump was instated. And we saw overnight significant moves occurring in the S&P 500 and the Dow Jones. I mean, we were looking at a 3,000-4,000 point move potentially occurring overnight. Now, this didn't take place is purely because from what we saw that the US election, the deciding factor came over a number of days rather than just the overnight that was previously expected. So instead of finding out 3, 4 in the morning once the counting had begun, actually went on for a whole 7 days. So the slow sort of answers that we were looking for came into the market, and we saw very, very short bursts of moves occurring. But again, it wasn't that spectacular move that you would normally see from a normal sort of US presidential election. Brexit was a lot of it was discounted. A lot of it was already discounted. The biggest surprising move would have occurred if there was a no deal Brexit. A deal Brexit, a deal occurring with Brexit, that was already priced in. So no deal Brexit, there was a much larger downside for cable, and that didn't occur. There was some trepidations to sort of that taking place, especially as we came to sort of the final line in December. But again, it didn't really lead to anything. Also, you've got to remember, by the time we found out that there was a deal occurring, this was over the sort of holiday break. So a lot of the traders and portfolio managers would have been away from the desk, and just it just didn't lead to the same oomph that you would expect with any other type of sort of political event occurring. Now, we have seen dollar weakness occurring, and that would have been on my list if it wasn't for the likes of, say, Bitcoin and crypto assets booming, making sort of three-figure sort of percentages, and Tesla outperforming, Zoom outperforming. So dollar index, we've seen it moving negative throughout the year. But again, it's still just below the 90 handle from what I'm seeing right now, just below. It's around 89.75, 89.75. Now, this is for me a decent one, actually. Out of this list, actually, this was the surprising one, the growth of retail trading. I mean, with COVID taking place and many individuals, working from home or being put on, what's the word? I've forgotten now what the word is. But, I mean, so when most individuals were put out of work, not out of work, but they were getting paid on a monthly basis. But again, there was no work for them to carry out. What we saw was that they started to look at other ways of making money, and a lot of individuals actually went on to open up, a trading app such as Robinhood, put in some capital in there and started trading the market. So we saw a huge influx of retail traders stepping in. In fact, there was almost whale types of trades taking place where groups of Robinhood traders discussed the markets and placed trades together and took much, much larger positions. What we're seeing now is that because of technology and how easy it is for anyone to be able to trade markets from just a simple mobile app now, through likes of Robinhood, it's now been where the power has almost shifted away from institutions. I don't see that institutions have the same amount of buying power as we've seen the amount of trades coming in from retail markets. So that for me was a huge surprise in 2020. And as I mentioned a little bit earlier in regards to reallocation of assets, what we saw was that fund managers had to quickly adapt to those current environments and really analyze their portfolio and look for assets that had alpha in comparison to the assets that were likely to be hit most because of COVID. And that's why we saw a lot of risk on and risk off scenarios occurring.